all three of the major asset classes, certainly that I look at in emerging markets, I think are still very interesting. So that means FX, local currency bonds, and dollar bonds. That said, there's a lot of good news priced in. There's a lot of good news in terms of the market taking a view that the US will likely achieve some form of a soft landing. And then obviously there's the dynamic associated with what we've already been talking about with the central bank policy outlook. So if you look at where emerging markets generically, or let's say we look at sovereign credit, the JP Morgan MB index, that's performed very, very well over the past several weeks. That doesn't mean it can't continue to perform well. And remember, the starting point for this year, for the MB at least, is a yield of around 8%. That's a much, much higher yield than this time 12 months ago. So, you know, the emerging market outlook, I think, remains still relatively favorable. A lot of the, as I said, you know, the performance has already been seen over the past 8 to 10 weeks. We think most likely you'll have a little bit of a grind tighter in the weeks ahead. But you do need to remain quite strategic here because the market, as I said, does price in some form of a soft landing in the US. There's obviously risk associated with that. We've already all seen some of the weaker earnings numbers coming out in recent days and weeks from the US and elsewhere. And so the risk of some form of a recession, perhaps earlier than some of the market is expecting, is clearly one that we need to bear in mind. The other critical thing with emerging markets is flows into the asset class. And last year was a very, very weak year, one of the weakest years really on record for flows into the emerging market asset class. And this year we've started to see some tentative reversals of that. So certainly the January data look pretty good. And clearly if you're going to start to see more meaningful flows come back into the asset class, that's going to support the technicals. And that potentially suggests that the positive squeeze that we've seen in recent weeks will still have some way to run.
And Nick, we seem to be getting a lot of promise from the Chinese authorities, whether that's the PBOC or whether it's at Politburo level, that they will now continue to support the reopening fiscally in China. To what extent does that also improve sentiment, do you think, towards the broader Asia emerging market complex?
Yeah, China is critical for the global economy, obviously, and more so for emerging markets generically. Commodity demand, general overall global demand as well. We believe that the China reopening is the real thing. It's going to continue apace. Of course, you can always think and imagine and envisage scenarios where that gets turned around. But those are quite extreme sort of tail risks, if you like, or unlikely events at this stage in our estimation. So clearly emerging markets generically have already seen something of a bounce from this China reopening. As you correctly suggest, a lot of that price action has taken place in the broader Asian region for obvious reason. That's much closer to China from a trade, from a travel and tourism perspective, from an investment flow perspective as well. So we do think there's some more to run there. But I think also you'll continue to see some positive dynamics towards emerging markets more broadly as a result of this continued opening up.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.